My name is Ty Bernicke, and I'm president of Bernicke Wealth Management. And one of the largest expenses that you'll have in retirement is taxes. And it's always surprising to me how little time people spend into planning out how to minimize taxes in retirement. Most people have an investment person, and most people have somebody that prepares their taxes, but many times the tax preparation person or the CPA or whoever it might be, they're not going to ask questions about how much you currently have in your IRA or in your Roth IRA or what other assets that you have and what will be your future income streams and what are you going to be doing for health insurance prior to retirement. And all of these different questions are so important to planning out what you should be doing today to minimize taxes in the future. And most people haven't even been through this process once in their lifetime. And the reason that I think it's so significant today, probably more than ever at any point in my career at least, is because of the state of how large our national debt is relative to the size of our gross domestic product or GDP, also known as the economy. So if you look at the debt to GDP ratio, the size of our national debt relative to the size of our GDP is as high today. It's higher today than it ever has been, including coming out of World War II. And when you look at what happened following the last peak we had had in our national debt, the governmental policies that followed included very high the highest average tax rates were much higher back then than they have been recently until we got the debt under more control and taxes then subsided to more reasonable levels. But certainly I and many others are worried that we're going to eventually have to pay this debt off. How are we going to do that? It seems reasonable to assume that higher taxes might be coming down the pipeline. And the reason that that can be such a significant issue for many of the people that we meet with is attributed to the fact that many people that see us prior to retirement have a very large portion of their nest egg set aside in what we call the tax-deferred bucket. So the tax-deferred bucket would include things like IRAs and 401ks, 403bs, 457b plans. There's a variety of different what we call tax-deferred assets, but most of the different investments that fit into this category have similar characteristics from the perspective that when you put money into this bucket, it goes in on a pre-tax or a tax-deductible basis. The money grows on a tax-deferred basis. However, when you take money out of this bucket in the future for qualified reasons, the 100%, generally 100% of what you take out is going to be subject to taxation at that moment in time. And even if you do not want to take money out in the future, you're going to be forced to at 72 when required minimum distributions start. So at the age of 72, you have to take out a certain percentage, and that percentage that you take out continues to increase during the duration of your retirement. So when you think about this bucket, the money that you leave in this bucket is 100% at the mercy of future tax increases if that occurs. And so a few things to consider when you look at this. If you have the majority of your retirement in this bucket, what implications does that have for you for the future? Do you have a long-term distribution strategy that considers the impact required minimum distributions will have in the future? Again, if you have this new source of taxable income coming in when required minimum distributions start at the age of 72, it's reasonable to assume that it could push you into a higher tax bracket. It's also reasonable to assume that tax rates just might increase for people in your income tax bracket in the future, which might make it more advantageous to look at getting some of the money out of this bucket into other buckets at this moment in time. Another question that's really important to ask yourself as it pertains to this bucket is, do you need health insurance prior to the age of 65? So for people who do not have employer-sponsored health insurance prior to the age of 65, when Medicare kicks in, many people will go on Affordable Care Act insurance. Affordable Care Act insurance the price you pay is partially dictated by your modified adjusted gross income. And distributions from the tax deferred bucket count towards modified adjusted gross income. And so making sure you have a plan to mitigate that cost in the future is extremely important. One item to consider for some people, doesn't make sense for everybody, but one item to consider for some people is what we call the tax-free bucket. This would include things like Roth IRAs, Roth 401ks, Roth 403b plans. There's even Roth 457b plans. And with this bucket, you do not get any special tax advantage up front. However, money in the bucket grows tax-free, and when it's taken out for qualified reasons, the money comes out income tax-free. And so in addition to that, there are no required minimum distributions on these different investments if you put them into a Roth IRA. If you leave money in a Roth 401k or a work retirement plan, there potentially is required minimum distributions, but Roth IRA investments, there are no required minimum distributions. So the money grows tax-free. It comes out tax-free for qualified reasons for you. If you don't spend the bucket during your lifetime, you can leave this money to your kids. Your kids can take income tax-free distributions over a 10-year time horizon. And more importantly with this bucket is you're not at the mercy of increasing tax rates in the future. You can protect yourself from potentially increasing tax rates in the future. So if you want to learn more about different tax planning strategies, our website at Bernanke.com has a ton of information, educational information on this topic. But even more importantly, if you've never actually talked with somebody that has asked you what your current income streams are, what your current tax, what your taxes have looked like, and collects your tax return, your most recent tax return, looks at your current income streams, your future income streams, what you're going to be doing for health insurance prior to retirement, how much you have in IRAs, how much do you have in Roth IRAs, what's your plan for Social Security. All these little variables make a huge difference in what you should be doing today. A lot of people will wait to have this type of analysis done when it's too late and you don't have a lot of options. The sooner you get on putting together a plan for what you're going to be, what you want to do for the future planning, and you start organizing your assets in advance of this happening, it can make a big difference in helping you optimize the opportunities that are available for you today that might not be available 2, 3, or 4 years down the road. So if you want to take advantage of going through that process, in 10 or 15 minutes, you can have a phone call with one of our advisors by simply clicking the link at the bottom of the page and setting up a time to go over things and having them kind of steer you in the right direction and hopefully show you what you might be missing out on. So there's no cost or obligation to take advantage of that. Hope you talk to somebody on our team here that can help give you some ideas that are more impactful than what we were able to cover in this short video today. So thank you for joining me. I hope you learned something that's beneficial for your unique circumstances, and we look forward to talking with you in the future.